Hey guys, so this is, I'm Cameron Labrie, this is here with Nick Binniger. So what we're going to do here today is we're going to role play the mortgage protection script that we use here at Syndicate. So what we're going to start with is I'm going to be the salesperson, you're going to be the client here. I'm going to go through the actual regular mortgage protection script for someone who's healthy, and then we're going to follow up and do one for equity protection, okay? So Nick, for this, just to make it where I'm not just dealing with Nick, I'm going to say just Joe and Mary. That's typically what we do in that scenario.
Perfect.
So you're going to be Joe and Mary if we have a husband-wife scenario, okay?
Perfect.
First one, let's do a young 32-year-old and 34-year-old husband and wife. Okay? Awesome. Hey, Joe, this is Cameron. I'm the state underwriter assigned to the mortgage protection case. It looks like we had a meeting scheduled right now to go over everything. Is now still a good time?
It is, yep.
Awesome. Well, can you grab me a pen and piece of paper real quick?
Yep, just 1 second.
Awesome. Well, let me know when you're ready.
All right, ready?
Perfect. All right, great. So I need to give you my first name, my last name, and my license number here with the state and the federal government before I can go over anything.
Just one quick question, Cameron.
Yeah,
How did you get my information again, and what is this regarding?
Yeah, so when you actually get a mortgage, right, a lot of people ask us, right, when they get that mortgage, it actually goes into public information, and we're one of the first people to get it and make sure that you have something to cover that mortgage in the event of death or sickness. Again, a lot of people like this set up because it's a 90% foreclosure rate in the event they don't have something like this set up. So again, you got that pen and paper for me?
Yeah, and then do you work with my bank, my lender?
No, unfortunately, if your bank was licensed to do it, you already would have had it set up, right? Again, so you got that pen and paper for me?
Yeah.
Okay, awesome. So my first name is Cameron. My last name is Labrie, and my license number is 200-34207. Okay,
Got it.
And then we'll do a cut here. So right here, if you noticed, I addressed his concerns, and then I went right back into the script. And if you actually have the script along, which you'll have this in the module itself, you'll be able to see that I went right back into the script. Okay, so now we're back into the script itself. Awesome. Can you repeat that license number back for me?
Yep. Blah, 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 blah.
Awesome, perfect. So again, my job is to make sure you have something set up that covers the mortgage in the event of death or sickness. Now, here's what we'll do today. Now, all these plans are based on age and health, which requires me to ask a couple questions about your health and your mortgage, and that will allow me to find the very best option for you that will be customized to you and your situation. Now, I'm just going to ask you a couple questions. I see that mortgage amount here is $230,000 there with Rocket Mortgage.
That's correct.
Now, are you married, engaged, single, divorced, widowed?
Engaged.
Engaged, awesome. And what's your wife's name?
Mary.
Mary, okay. Now, she's there with you right now, right?
She's not actually.
She's
at
not?
work, yeah.
Okay. We're going to assume she's with you.
Okay.
Shit. We'll go back there. Now, is Mary there with you right now?
She is, yep.
Okay.
I got you on speaker so she can hear.
Okay, awesome. And now, for both of you, have either one of you had cancer, heart attack, stroke, diabetes?
Nope.
Any other sort of major health issues outside of, minor anxiety or minor blood pressure or anything like that?
No. She has like an irregular heartbeat that she was born with.
Okay.
Something like that. So yeah, that's
okay. Yep. And no smoking for either one of you?
No.
Okay. All right. Awesome. So again, we want to make sure your mortgage is protected in the event of death or sickness. So to do so, we've come up with some policies that include critical, chronic, and terminal illness riders. They would pay out in the events of such as cancer, heart attack, or stroke. Now, out of the two of you, between you and Mary, which one is the main breadwinner?
I am.
You are? Okay. So obviously, Mary, what is your current plan to cover the mortgage there in the event of Joe's death or sickness?
I've got a policy through work. That covers, I think, triple my income.
Okay, awesome. And you don't plan on working for the rest of your life, do you?
I hope not.
Okay, so obviously, if you understand how work coverage works, it only stays with you if you are at the job. If you lose your job, quit your job, retire, get fired, it's gone.
I think I can keep this one when I leave.
Unfortunately, there's not one that works like that. So it's actually like a company car. Like, for example, what type of car would you, if you had the best company car, what would you like to drive?
Prius.
Prius? Okay. So let's say you had a Toyota Prius and you love that Toyota Prius. It's saving you all the gas. It's a hybrid. You love it. And then you leave that job and you want to keep a Toyota Prius, right? And it's 2040 and you just love that vehicle. Well, now you've got to pay full price for that Toyota Prius, right? And something else here to note as well. I mean, the federal government is the largest employer of employees in the entire world, and they still don't have insurance that stays lifelong for people, right? So if they can't figure it out, that little company you work for 40 people, they don't have it figured out as well. Okay.
Got it.
So what we do is we make sure that you have something long term, and that when you do, quit your job or retire, that you're still with you. Now, Joe, I guess what is your current plan to cover the mortgage in the event of, Mary's death or sickness?
We don't have a plan in place.
You don't? Okay. Now you said you're the main breadwinner. You feel comfortable that you could 100% afford the mortgage if she were to die or get sick?
I could probably afford it. Yeah. It'd be tight, but I could afford it.
Okay. Okay. So I guess what if we? Sorry, we changed the script here a little bit. I'm sorry. We used to have another plan where it says ideally, what would you like? Remember that? Mm-hmm. I'll ask that. Ideally, I guess, what would you like it to look like for both of you if someone were to die or get sick?
Considering I'm the main breadwinner, and surprisingly understanding how the work coverage works, probably would want to get something set up that, for her at least. And then if there's room, maybe, look at insuring her for me. Okay.
All right. Yeah. Perfect. Well, we can absolutely do that. So obviously I'm going to show you a couple different plans, and then we, obviously can go from there. So again, for you there, Nick, to cover that full mortgage, it would give you a return of premium. So at the end of 30 years, you get all your money back. It would cost you this much. It's going to cost you $250 a month. Okay. Mm-hmm. The second option is the same thing, but at the end, you're going to get all the riders. That's going to stay with you, but you're not going to get any money back. And that's going to be, $162 a month. And the third plan, we're actually going to just cover only about 50% of the mortgage for you if you were to die. And that plan is going to run you $82 a month. Now, Joe, knowing you have nothing to protect you and your mortgage, I guess out of these three options, which one makes the most sense for you and your family?
Does the first one, so you said the first one, you get your money back? How's that work?
So at the end of 30 years, let's say you don't make a claim, the insurance company rewards you for not making a claim by just giving you all the money back. They made all the money by taking those premiums, they've reinvested it, they made what they want to make out of it, and they're just going to give you that back just for not making a claim. Does that make sense?
Yeah, and does that plan come with those living benefits you talked about?
It does. Okay. It's the same thing as the second plan, except you get all your money back. And it's just a little bit more expensive because, again, the company's taking the risk and they're still giving you money back at the end.
Probably the middle plan, but are you able to upgrade down the road? Like if I wanted to change it, or
so ideally we do recommend that you get the first plan, because if you do try to upgrade it down the road, you're gonna have to upgrade it at the attained age.
Gotcha.
Which means, let's say you wait 10 years. Well, if you're 35 now, and it'll be 45. It's gonna be way more expensive.
Gotcha. And how much was the second plan again?
The second plan was $180.
Okay, so we'll probably choose the second plan, but man, I really like that first plan. It's just $250 is a little steep. We'll probably have to talk it over and go over our budget and stuff.
Okay, why don't we do this? Why don't we get you the second option, and then if you guys look at your budget and think you can actually afford more, before we actually issue the policy, we can make it a return or premium plan. Does that sound fair?
Yes, that sounds fair.
Okay, and then you're going to go into the application. Okay, now in that situation, you may want to address the wife there. Again, if it's already tight with the budget, I'm going to try to go for the main breadwinner to get the insurability there. You're obviously the one that we would want to take care of there, the one who's actually bringing in most of the income. But in that situation, you may want to look at both of them. Just kind of play it by ear. That was pretty obvious. The main breadwinner, take care of him, and then obviously go for the wife secondary. Plus, your health was better than there. You said you had a regular heartbeat, if you guys noticed that when you said that there. So if you have an irregular heartbeat, you're not going to be able to get term, most likely, depending how severe it is. But if you have an irregular heartbeat, typically an arrhythmia is going to be a final expense, which for a 35-year-old is going to be a little bit tougher to sell because they want to see the full mortgage covered. Mm-hmm. So awesome. So let's do that same thing now, and then we'll go into what's called equity protection. Okay, which again, if we have that module, we'll go over the equity protection and what that looks like. Again, what we're doing is we're making sure that when the person can't necessarily afford, or they can't
Medically
actually
qualify.
medically qualify, or they're just too old and